With tariffs flying, exports wobbling, and inflation caught between a rock and an American ego, the question on everyone's mind is, will Trump's trade war spike the OCR, and could that slam the brakes on New Zealand property all over again? Mark Lister, Investment Director at Craig's Investment Partners, is back to unpack how global politics might just jack up your interest rate and why your Kiwi mortgage might depend on decisions made in DC.
Financial freedom faster. Financial freedom faster.
If you like making money rather than watching everyone else do it, hit that subscribe button and get ahead, because this is New Zealand's fastest growing real estate and investment show. Mark, if this was Monopoly, would Trump have just flipped the board and called it the art of the deal?
I'm not sure I'd call it the art of the deal, but he has definitely flipped the board. We've seen huge volatility across global markets since last week's so-called Liberation Day. In the 2 days following that announcement, we saw the US share market fall 10.5%. And if you go back to World War II, there's only 3 other times where we've seen a move as that big in the space of 2 days. Once was 1987, Black Monday. Another was in 2008 during the GFC. And the third occasion was in 2020, March 2020, during COVID. So what we've seen lately is something that is very, very rare, that level of volatility.
So how exactly does one orange man in Washington make my Kiwi mortgage more expensive?
Well, I think the good news for mortgage holders or homeowners is that the outlook for mortgage rates in New Zealand hasn't changed dramatically. In fact, I think you might actually still see the OCR cut today, and the path of the OCR beyond that is that it might end up lower than we thought a couple of weeks ago. So mortgage rates still expected to remain at current levels or drift lower, despite what you're seeing going on.
Could Trump's trade war actually force the RBNZ to raise the OCR just when we're all catching a break?
You're right. The OCR will be dependent on the inflation outlook. But I think what we'll see, or what we're expecting, what I'm expecting, is that in the US, you might see a bit of upward pressure on inflation because these tariffs will act like a tax. And remember, it will mean that US consumers have to pay more for all of these imported goods. So there will be upward pressure on inflation in the US, and that will put the US Federal Reserve in a really difficult position because they're going to face slower growth, maybe even a recession, but with inflation that's creeping up, which means they are between a rock and a hard place. But other parts of the world won't face those same inflationary pressures to that degree. And in fact, they might actually see some disinflation as goods and services, well, goods primarily, that were destined for the US end up going to other places for cheaper. And then you look at what we've seen with oil prices and so forth, they're coming down. So I don't actually see an inflationary spike in New Zealand. What I do see is the potential for that slower growth in many of our trading partners like China and so forth. So when you put all that together, I think the OCR will still be cut today. I think it'll still be cut in May. And then it might actually finish the year starting with a 2, which is a little lower than we thought before. Talked to a few real estate agents in the last few days, and they, to be honest, were quite excited by the prospect of more OCR cuts than we might have thought because of what we're seeing. And that is valid. That's an important dynamic, and it's an important driver of house prices and activity and so forth. But you've also got to balance that against some of those other things that drive the housing market, drive the property market, like incomes, like the labour market, like employment, like economic growth. So even though you might have some positives coming through in terms of lower interest rates than we might have thought a couple of weeks back, you've also got a few challenges, which might be a slowing Chinese economy, recession in some parts of the world. Those things can put a dampener on what we're seeing here in terms of economic activity. If that causes more uncertainty, if it means that unemployment potentially rises more than we expected, you've got a mixed bag of drivers for the housing market, haven't you?
Do you think the RBNZ is watching Trump's policy announcements as closely as we're watching the house prices?
Oh, 100% they will be. And they're in a bit of a difficult position because what can you really say when you don't have clarity on how things will play out? And it's the uncertainty that is really keeping markets and investors on edge. Will we see further retaliation from other countries, and will we see sort of a tit-for-tat trade war playing out? Or are there some negotiations taking place behind the scenes? And we're soon to get some positive news in terms of a relaxation of some of those proposed tariffs. It all depends on which one of those paths we take. That is what will define the outlook. So I think for the Reserve Bank, I think they will cut the OCR. They'll talk about sort of some of those uncertainties and there'll be a strong word of caution, but they don't know either how the outlook will develop. So they will probably play their cards close to their chest because they simply don't have full information.
Just a reminder, this is not just a YouTube channel, it's an unfair advantage in the property game. Subscribe now, stay ahead of the market, and never again be the person who says, I wish I'd known that sooner. Mark, how fragile is our OCR forecast really? Could a full-scale trade war derail the entire rate path?
Well, I think for me, it feels clearer than we're seeing in other parts of the world. In the US, for example, the Federal Reserve is on hold. Their OCR, the equivalent, is at 4.5%. And they peaked at 5.5% last year, just like we did. So they've come down from 5.5% to 4.5%. And they're sort of on hold because the economy's been very strong. And now that's changed. The economy is probably not going to be quite as strong. So markets, in their wisdom, see more Federal Reserve rate cuts ahead. They see 100 basis points of rate cuts. So that would see the Fed end up at 3.5%. Now, I just wonder about that, whether they'll be able to do that, because if you've got inflation that's pushing higher because of the tariffs, they might sort of be in a bit of a bind. Because they've got to target inflation. Here in New Zealand, things look clearer to me. You know, we're at, what are we at? 3.75. By the end of the day, we'll be at 3.50. In May, I think you'll get another 25. Then you're at 3.25. Inflation is in the right place, and it will probably remain in those levels. And if the economy slows, then maybe it will even more so remain where it needs to be. And at the same time, if you're getting slowing growth, if you're getting more uncertainty, if you're getting nervousness out of our big trading partners like China, like Australia, then I can easily see the OCR coming down to, let's say, 2.75 before the end of the year. So I think that is something we've got on our side. We at least have got that clearer path for monetary policy from here on.
How do average investors prepare for a global slowdown that gets triggered by something they can't vote on?
Yeah, well, it's always uncertain, and it's always makes you nervous and worried. But these periods of markets up and down, they're not anything that we haven't seen before. For those of us who've been in the market a while, since 1960, I think we've seen 34 corrections in the United States. That's a decline of 10% or more. And I think we've seen 9 or 10 recessions and bear markets where the market goes down 20% or more. So you tend to get these 10% declines about every 2 years. You get the bigger declines that usually go hand in hand with a recession every 6, 7, 8 years. So it's not completely unusual. And if you're a long-term investor in shares, just like if you're in real estate, if you're in business, if you're in farming, you will get those periods from time to time. So long-term investors, no need to panic. Talk to your advisor. Just make sure you sort of stay close to your Kiwi Saver manager or whoever looks after your money. You might even see opportunities on the way through. So it's good and bad, but the people that I only really worry about are those who maybe have a very short-term time horizon, but they have maybe ended up with a lot of shares in their portfolio, which is really just a mismatch of objectives versus approach. So for those people, maybe you're going to find yourself in a difficult spot. For the rest of us, our Kiwi Saver funds, our share portfolio, our real estate portfolio is a long-term asset, so view it as such.
Thanks for your insights, Mark. Mark Lister, Investment Director, Craig's Investment Partners. I enjoyed reading your recent report and look forward to chatting to you again soon.
Thanks for having me, as always.
Just a reminder, property investing isn't for people who sit on the sidelines. It's for people who take action. And the first step, subscribing to the fastest growing investor channel in New Zealand. So you're always one step ahead of the market.
More cash, passive income coming fast. Make your money work for you. Live the dream, it's overdue. So don't just wait, take control. Mortgage HQ will make you bold. Financial freedom's in your hands. Take that step, it's time to